If you look at uncertainty around us, it's probably at a level that we have not really seen in the last 60, 70 years.
A lot of the noises you hear or a lot of emotions you hear are one of despair, saying that last year we've not seen any returns. Actually, the market has not done that badly.
Median return in S&P 500 last year was actually minus 6%. There was a big shift in the market. Only few select large cap stocks really led to the overall return in the market.
There's some very counterintuitive thing that has happened, right? Which is central bank has now cut rates by 125 basis points, but actually the 10-year bond yield has tightened. It's kind of gone up.
It's a phenomena that we have seen now play out across the globe. The starkest example is Japan, right? Where bond yield never used to budge from 0 point something, and now 30-40 year bonds, they are yielding 4%. Net, actually, if you look at most asset classes over the last 18 to 24 months, most asset classes are actually higher than where they were 18 to 24 months ago. You spoke about the Indian market. So Nifty actually is up 10% last year in INR terms, about 3% in dollar terms. Most emerging markets are up about 30 to 40%. US markets were up about 17%. Even Europe was up nearly 30%. Good news is we are seeing some degree of turn in earnings. We are expecting this year we will back to a double-digit growth. Of course, we will not be back to the 20% plus kind of growth rate.
May you live in interesting times, goes an old Chinese curse. And I think we are living today in extremely interesting times. What you've seen over the last many years actually, since COVID, and particularly in the last year and a half, is extreme volatility in all kinds of market spaces. We saw a dramatic fall following COVID on every asset. Subsequently, we saw a super dramatic rise across every asset class. And in the last 18 months or so in India particularly, we've seen all kinds of weird things. Equity markets seem to be at the index level showing decent returns, but people's portfolios are all over the place. Many are in deep red. Commodities showed a very sharp rise, and then in a matter of 2 to 3 days, some commodities lost 30-40% of their value. Currency seems to be, after a long period of stability, the Indian rupee, as an example, has suddenly depreciated very dramatically. So there are a few fundamental things that are causing the churn in all of these spaces. Our open dialogue topic today focuses on these areas. And joining me to discuss this is Ashish Gupta. Ashish, welcome.
Hi.
So Ashish, what's happening?
So I think markets are really a reflection of what is happening around us, right? And if you look at uncertainty around us, it's probably at a level that we have not really seen in the last 60, 70 years. Globally, the order-based system is kind of faltering, and boundary that we all thought existed no longer hold firm. So I think markets are a reflection of that itself. Frankly, I will disagree with you on one aspect. I think the markets have not been actually as volatile as they should have been. We have seen now geopolitical issues coming around across the world, including in our neighborhood. Right. And in addition to that, the uncertainty on the policy front. And there are data sets that show that current level of policy uncertainty is at a historic high, because it is not surprising, right? Because every morning you wake up and you read a tweet that tariffs have changed somewhere. Even when countries enter into free trade agreements or trade agreements, tariff rates get changed unilaterally, literally a few weeks down the line. So the degree of uncertainty that is there in the world today is probably the highest that I have seen in the last 3 decades. But actually, the volatility in the markets is probably not to that extent. Of course, having said that, I totally take on board your view that there has been a sharp drop in many asset classes. I think the most recent one being silver, where the price crashed by about 30%. But actually, we take a step back and look at silver prices, it's probably still higher than where it was in October, November, right? So there was some wild speculation that happened and took the price up very sharply, and we saw a correction in that. Net, actually, if you look at most asset classes over the last 18 to 24 months, most asset classes are actually higher than where they were 18 to 24 months ago. You spoke about the Indian market. So Nifty actually is up 10% last year in INR terms, about 3% in dollar terms. Most emerging markets are up about 30 to 40%. US markets were up about 17%. Even Europe was up nearly 30%. If you look at commodities, with the exception of oil, most commodities are also higher. If you look at real estate prices across the world, except for the few select pockets, real estate prices are also higher. So really today, very few asset markets are in a downtrend. I think Bitcoin is one of the few which has seen a very significant pullback, right? And there are people say technology issues behind it. But I would say that volatility in the markets today is lower than what it should be given the uncertainty around the world.
Understood. Great. So, Ashish, there are many different areas here. Let's take one by one, all of them. So, we have equities, we have commodities, let's say gold and silver, we have real estate, we have currency.
Yeah.
And then there are the maybe the new age assets like Bitcoin and so on and so forth. So maybe we go one by one. Let's start with equities.
Sure.
And let's just talk a little bit through the movie of the last, let's say, couple of years. And your assessment of where we are right now and why the market is behaving in the way that it is behaving. You did mention that Nifty is up 10%, which is absolutely the case. But if we go maybe a little bit lower, that's perhaps not the case.
But the median return in NSE 500 last year was actually minus 6%. Right. So there was a big shift in the market. Only few select large cap stocks really led to the overall return in the market. There are multiple reasons for this. One, to start off, last year we were coming on back of multiple years of uptrend in Indian equities, so the valuations in India were higher. Secondly, over the past 6 quarters, we had seen a very significant downgrade in earnings, right? All through 2021, post-COVID till 2024, we had seen market earnings grow quite healthily. It was almost a 23-24% CAGR. And after growing at such a pace, Nifty earnings, which last year were expected to grow at about 17%, saw significant earnings downgrades. And in the end, we ended up with a single-digit earnings growth. So earnings growth also came down, and there was severe earnings downgrades, and that's what kind of also made the market even more expensive. So the market multiples were high, and it became more expensive because of the earnings miss. On top of that, if I look at some of the technical factors, globally, capital started chasing the tech and in particular the AI theme because it is touted to be the most disruptive technology. And whether you look at capex, whether you look at private investments, including venture capital or public markets, more and more of capital is getting directed into either AI plays or beneficiaries of AI or people who are kind of providing the shovels for AI, right? So even if we exclude the public market, even in the private equity and venture capital area, nearly 2/3 of money have been directed towards this theme, right? India does not have any a kind of visible play as yet on that theme. So India kind of sat out of those flows. And at the margin, India is considered potentially a loser from AI, given how much of GDP contribution our IT services industry provides. So there is potentially even a risk of that. Also, as money started going to multiple other markets, India, which has historically seen capital inflows, started seeing capital outflows. So last year we had almost $20 billion of FII outflows out of India. And even though domestic flows remain and retail flows into the equity markets remain quite resilient, given the democratization of investing as well as the fact that market returns have been so good, given the FII outflow as well as the large amount of IPOs and stake sales coming into the market, we saw a pullback in the market. In economics, there's always the flexibility, right? And the fact that we were seeing outflows actually both on portfolio side. So there were FII outflows of about $20 billion, but there's also FDI outflow of $80 billion, right? So in aggregate, there was $100 billion of outflows. Of course, the net FDI was still positive, but there was $100 billion of outflows if you aggregate FDI and FII, and that put currency under pressure. To manage the currency outflow, you had central bank intervening in the market. So a lot of the monetary action it took could not result in as much gain as it would have been able to with the degree of rate cuts it had undertaken during the year. So in that sense, the fact that there was outflow of money, it started affecting the fundamentals as well. So that's a couple of reasons on the technical side that you have seen a pain in the broader market.
Understood. So there are 4-5 things you said, Ashish. First is this fundamentally, at the end of the day, the markets they look at they are discounting future cash flows. So they are looking at how good the earnings are and how good is the expected growth of earnings. And they are ascribing a value to that number. And so fundamentally this multiples or the valuation, which is a price to book, price to earning, whatever ratio you look at, there is a certain expectation. The Indian markets seemed overvalued, which means that the price to earnings, let's say, was higher than what it should normally be. So this was one reason. Compounding to this is that the earnings started to slow. So not only was the valuation higher, the growth also seemed lower, which means that actually the price earnings will become even higher because of the slowdown in the growth in the earnings growth. And earnings growth started to slow down because the external environment was slowing and demand was slowing, and India went through a phase of slow demand. So fundamentally things started to look worse. Added to this, on the technical side, we had a very large supply come into the system through secondary sales, IPOs, private equity selling and the like, which basically meant that new paper came into the market. So the demand side was already a little jittery given the valuation, plus we had more supply. So they kind of became double jittery, and we saw lots of kind of prices not increase and in many cases fall, particularly in the more overvalued pockets. So that happened. And in addition to this, there was a FII outflow, which was a combination of 1 and 2, I guess. FIIs also saw that it was overvalued, so they said, I'll sell this and I'll buy maybe some other country, maybe China or whatever, right, where it is looking undervalued. Plus, a lot of the folks actually saw that some companies were getting more value for the Indian subsidiary than the parent itself, so they sold here and they took the money out. all sensible things to do. But because of all of this, a lot of outflow happened. When the outflow happened, the exchange rate fell. When the exchange rate fell, actually the dollar returns looked even worse, which would have further forced people to take money out, I guess. So all of this kind of compounded came together and created the situation. So to follow on, one is, let's take on this IPOs a little bit, right? Because we've seen a spate of IPOs over the last year. And I think more are coming as well. It's not that it stopped. So firstly, will be helpful to, just if you can just demystify what is an IPO, what happens, why is it different from a normal buying and equity of buying and selling of equities, and secondly, what has resulted in so many IPOs coming out, and how should people think about IPOs?
So there are lots of questions there. So IPO, as the name suggests, is initial public offer, right? So it's the first time a company is offering its stock to the public, right? The main difference between buying in an IPO or buying a listed company is that a listed company, more information is available through the years. It has a track record of both its earnings and stock price movements. In IPO, really, it's the first taste of the company that broader investing public is getting. IPOs are not a new phenomena. And frankly, really IPOs or public offerings have been popular since the 16th, 17th century. And one of the most well-known public offering was of the Dutch East India Company. So initially, IPOs were used primarily as a tool of raising money, as well as diversifying ownership and risk, right? So if someone is embarking on a voyage on a ship and not one person wants to hold the risk, you kind of get multiple people to invest in it. This thing kind of gained prominence in 17th, 18th century for projects that had large capital outlays. And so a lot of industrial revolution needed funding, building of railways, canals, etc. So that's how public offerings came into vogue. And when stock exchanges came into being, and actually India also has a very rich history. Just recently, BSE celebrated its 150 years of existence. So BSE was Asia's first stock exchange, and it got set up in 1875. So even in India, investing in stocks came into vogue, and companies came to the IPO market. Of course, over the years, the IPO market has become more sophisticated, much more regulated, and the key was really in early 1990s when SEBI came out and formulated regulations around the minimum level of disclosures, etc., that need to be there. Because one of the challenge between an IPO versus a already listed company is the amount of information that you have, right? So it was much more of a Wild West pre-1990s, and after 1990s, that regime changed. Another important change was that I think pre-92, the IPO price was fixed, and it was determined by a CCI, right, controller of capital market. So there was a government body which used to have a mathematical formula, and it used to decide the price of IPO, and everyone had to kind of bid in the IPO. Generally, it was a conservative formula, and so people bidding have a good chance of buying a undervalued asset, right? And that there were a lot of people chasing that asset. So I think people have that recollection that IPOs are like lotteries, right? So if you get the allotment, you are going to make money because when it is coming to IPO, it's cheap. Now that has changed over the years, right? So not only did SEBI come out and streamline regulations around disclosures and even use of proceeds, etc., but it also made the pricing free and market determined. Right. So it's not necessary that if you're buying in an IPO or the valuations are really cheaper than the listed market. But I think that psyche still persists. So people look at IPOs literally like a lottery. And I think all of us in the capital markets and in the media love the buzz that comes with the IPO and the frenzy of the listing day gains. But if you look at data over the long periods of time, actually IPOs don't really enhance your returns, right? In fact, if you strip out the listing day gains, I've done this analysis for the last 5 years. If you strip out the listing day gains, most of the IPOs have actually underperformed the market. So if you had put money in the Nifty on that day versus in the IPO, you would have made about 200 basis points more return on the Nifty than on the IPO. Of course, the listing day gain has made the average return on IPOs higher because some IPOs have listed with very large gains. If you look at the cohort of IPOs from 2024 till date, broadly, half the IPOs are underwater and half are above water, even for the IPO price, right? And the average gain is only about 4%. Right. Of course, there are about a dozen IPOs where the gain is 80-90%, but the average gain, if you had invested in each and every IPO in the last 24 months or so, would only have been 4%. So I think people should look at IPOs carefully, and not all IPOs are a lottery.
Right. So very interesting. IPOs since 24 over a 2-year period have given a 4% return, which means this is 4% CAGR or 4%?
4% return.
4% return, which means in CAGR terms it's maybe like less than 2% or something.
Yes.
Very, very interesting. Since you mentioned the Dutch East India Company actually went through many financial troubles and finally they went bankrupt. They had to be kind of wound down. So people who invested in their IPO, not sure they made money as well.
So actually, if you look at the 1995, right, the number of IPOs was in the hundreds and many of those companies don't exist.
Don't exist any longer. So buyer beware, and so, you have to apply your mind to see which IPO you are investing in. It just doesn't mean that everything will return. Very interesting, Ashish. So that is equities. Any other, like this mid cap, small cap, what's happened and what's kind of your reading of that?
Sure. So I think firstly in India, how mid cap and small caps are defined is also very different from how it's defined globally.
Right.
So globally there is a fixed kind of market cap, right? So you say, okay, companies above $3 billion are mid caps, or large cap less than $3 billion are small caps, right? In India, the way this classification has been done by cohorts. So the top 100 companies are large cap, the next 150 companies are mid caps, and 250 downwards are small caps, right? So the threshold of market cap or size by which a company is considered mid cap or the small cap actually keeps varying with the market. Right. So today, many of the mid caps that we have, so even a company that is got $10-12 billion market cap, because we have about 100 companies which have market cap of over $15 billion, even a $12 billion company will be called a mid cap. If we go back 7-8 years ago, a company of that market cap would have been called a large cap, right? So the thresholds are dynamic, right, in a market cap sense. So I think one should not really look at company necessarily just by that definition. What had happened was that some of the companies in the mid-cap and the small-cap space, particularly post the COVID recovery, were showing much stronger growth, right? Because they were in certain sectors that were coming out. So, for example, real estate companies or the hotels, right? So they were coming from a downturn. They were coming back in their earnings cycle. So the earnings growth was very, very strong, right? I spoke about the fact that Nifty earnings grew 23-24%, mid and small cap earnings growth were 30%, right? And as it tends to happen in the market, everything gets extrapolated, right? So the expectation of growth in these companies was even higher. And traditionally, these companies trade at a discount to large caps because large caps are more well discovered, better owned, better governance. So generally, they trade at multiples that are higher than mid and small cap because liquidity in large caps is also higher. So more institutions can invest in. But because there was expectation of very high growth in earnings continuing in these companies, their multiples actually went at a premium to large caps. If the average P on the Nifty was about 20 times, the mid cap and small cap Ps went up to average P was around 28 times. The median P was actually even higher at about 35 times. So these got even more overvalued. And therefore, when the earnings disappointment came in, which we spoke about earlier, the degree of correction that we have seen has been sharper in these pockets than in the large caps where lower growth was built in and you saw a lower degree of disappointment.
Understood. So it goes back to the same story of valuations, what were the expectations and then what was delivered against the expectations. In the smaller companies, the gap was even higher and so they've fallen perhaps even more.
Yes, and even the second dynamic which we spoke about of the technicality of flows also played out. Because if we go back to 2023-24, a lot of money started chasing mid cap and small cap. A lot of domestic money either directly going into these stocks or going into mid cap and small cap mutual funds. Right, and by mandate, 65% of money they have to invest in these cohorts. So the narrative became that because money is coming into these funds, valuations don't matter for these stocks and they will continue to go up. But it's a basic principle of economics that if demand goes up and price goes up, more supply comes. Right. And we saw in this mid and small cap more supply coming in. What we spoke about that not just private equity, but even promoters felt that it's a good multiple to sell the stock at. And you saw much higher supply in this mid and small cap space compared to the large cap. And therefore, the narrative that just because a wall of money is coming in, the valuations don't have an upper cap did not hold true.
Understood. And so if you look at a few data points, Ashish, so first is there was actually, when we done this supply episode, there was a very strong narrative of domestic money, SIP money coming into the industry, which was basically, keeping the tide high and hence all boats were rising. Subsequently, FI money started at that time also they started flowing out, but subsequently a lot more has happened. So today, if you look at this picture, what does it look like?
So the good news is that SIP flows have stayed resilient.
Right.
Flows into mutual funds have stayed resilient. I think on last year, almost 5 lakh crores of money came into the market through mutual funds. If you add the money coming in through insurance and pension plans, you can add another $20 odd billion to it, right? So domestic flows kind of stayed strong. But this was met by the increased supply. So last year, almost 100 IPOs came to the market. They raised about 180,000 crores. In addition to that, the stake sales, secondary market stake sales by promoters, private equity was more than 3 lakh crores. So literally there was 5 lakh crores of mutual fund and domestic flows and 5 lakh crores of stake sales. So they kind of offset each other. And the fact that there was an FI outflow on top of that, that kind of dragged down the market. If I look at this year, again, early days, but for now, mutual fund inflow, or even last month, was about 25,000-30,000 crores. So we are staying the course there. In the month of January, though, FIIs sold another $3 billion. So that has not yet turned. And IPO pipeline is still large. So from what we gather, what is already with SEBI in terms of DRHPs is worth 1 lakh crores, and another 1 lakh crores is in the wing. So if the markets have appetite, there is clearly close to 2 lakh crores of IPOs waiting to happen this year as well. And in addition to that, there is again 3.5-4 lakh crores of secondary stake sales, because the 100 IPO that happened in 2025, the 91 IPO that happened in 2024. So there are 3 IPO investors there who will be looking to exit. So again, if the markets have appetite, there is supply of 5-6 lakh crores even in 2026.
So there is 5-6 lakhs of additional supply beginning to come in. On the demand side, the SIP flows continue, but there is a FI outflow still happening.
Yeah.
So very likely this year also the demand supply will look either matched or actually maybe
Yeah, so I think the way to think about it is that again we have come to a situation where the direction of the market will be determined by the direction of FI flows. So if you look at 2022-23, we had a uptrending market even when FI flows were not available because domestic money was adequate. But as the domestic money is being met by the supply, I think the direction of FI flows are again determining the way the market is going.
Understood. And if you look at the split between the large cap, mid cap in the MF inflows, is that similar now or has that changed?
So that has moderated. So now you are seeing less inflow relative to what you were seeing in 2024 into the small cap funds. But even now, small cap funds are seeing good amount of inflows compared to history.
So historical levels, they are better.
Yes.
But compared to, let's say, 2 years back, it has moderated.
Yeah.
And a lot of the IPO flow will be coming in the small cap, mid cap space.
Yes.
I mean, it's not...
Although this year, there are several large IPOs also slated to come in. So this year, we will see a few IPOs on the large cap space as well in the telecom and fintech.
Right. Understood. But still a large number will be in the mid cap, small cap space. So there is a little bit of continued period of little bit of uncertainty, I would say. There, unless obviously earnings get pops up and suddenly FI start. So last point on this, which is I kind of alluded a little bit, which is what does it take for FIs to come back?
I think it's something we will know only retrospectively
When they come back.
when they come back. See, I think if we go back to the reasons that led to them going out, right? We spoke of 2 reasons. One was overvaluation and second was earnings disappointment, right? I think if we look at overvaluation, India is still not cheap by its historic trading multiple. So today, Nifty, we are trading at about 19.7 times. If you look at broader market, we are at about 26 times. So mid caps are about 26 times. Small caps are at about 22 times. So all these are still one standard deviation higher than the long-term average. But as we spoke about earlier, there was a big rally in other markets last year, right? So most of the other markets went up 30-40%. So on a relative valuation, India's premium to global market is lower compared to history. So India's premium both to MSCI Global as well as emerging markets is now lower than what the historic average has been. So a lot of the valuation premium that we used to enjoy has actually gone away today. If we come to earnings, good news is we are seeing some degree of turn in earnings. We are expecting this year we will back to a double-digit growth. Of course, we will not be back to the 20% plus kind of growth rate, but we will at least be back to double-digit growth. And if we just again very early days, but just last couple of weeks, at least the earnings disappointments and downgrades seem to have stemmed for now, right? So we don't. So on the earning downgrade side, also we are seeing the cycle kind of bottom out, and we are hopeful that we will end up with some 16-17% earnings growth. So I think these two factors are starting to work in our favor. What is probably still not working in our favor is that global growth is still very strong. So despite all the uncertainties we spoke about, global growth is very strong. And we are happy that in India's earnings growth is recovering. But if you look at the earnings growth in the US market, it is actually forecasted to also be 13-14%, right? US nominal GDP growth is, I think, at the same pace as India nominal GDP growth at about 8%. So we have seen kind of not just absolute growth in India being high, being the driver, but because India offered better relative growth that used to draw investors. So I think what will also be needed is some of these optimism around those markets to wane, some of that AI trade related optimism to wane, to kind of start getting flows back. The third factor or fourth factor is really what is happening to long-term cost of capital, right? And what has been quite surprising to see is that in the last 6 months, while multiple central banks have cut rates, long bonds, have not really seen any compression yield. So US 10-year yield is still around 4.2% or so. So, and as you know, equity is a long-term asset, right? So the cost of capital has to be looked at from what it is reflecting on the long bonds. So I think when that starts to moderate, that is typically also more favorable in terms of yield seekers start to come to markets like India because it is offering growth. So few things are changing. Our earnings growth is getting better. Our valuation premium has moderated. But I think our relative attractiveness will get enhanced when global yields also start to soften and some of the global growth estimates start getting pulled back.
Fantastic. Great to understand all of this, Ashish. So, netted to summarize, Indian equity markets went up because of multiple reasons. Primarily, earnings growth was solid, 23% CAGR, as you said. So that gave a lot of fillip to the market. In that, valuations became a little expensive, and then we had the earnings growth itself slow down quite materially last year, and so double whammy has resulted in markets cooling down. Supply increased significantly because of the valuation levels. That continues to be the case. So there are another 100 IPOs, as you said, or 1 lakh crore already DRHP filed, another 1 lakh crore working to get their DRHPs filed. So around 2 lakh crores waiting to hit the market, and including all the secondary stakes, you are seeing around 5 lakh crores. So there is still significant supply coming into the market. On the demand side, SIP flows are there, but FIIs are not there. And so there is going to be a little bit of an imbalance in favor of supply, which means that prices will continue to be likely under challenge. The benefit we have is that the earnings growth is coming back and our relative valuation is looking much better. But then obviously we have to see all of this plays out going forward. So now moving on to the next asset class, bonds. We didn't cover bonds in our first listing, but very important asset class. And you alluded to it already, which is there's some very counterintuitive thing that has happened, right? Which is, if you look at India as an example, central bank has now cut rates by 125 basis points. But actually the 10-year bond yield has, tightened. It's kind of gone up. So central bank is saying, I'm cutting rates.
Yes.
But market is saying, no, 10-year rates, we will take it higher.
Yeah.
So what is happening? Can you help understand this?
I think it's a phenomena that we have seen now play out across the globe. The starkest example is Japan, right? Where bond yield never used to budge from 0 point something, and now 30, 40-year bonds, they are yielding 4%. In India, we don't have so much of a problem on the fiscal deficit side, but it's bit more of a demand problem. So we don't have enough buyers for long-dated bonds, right? So the market has become very, very narrow. So both in the global markets as well as in Indian market, the reason long bond yields have gone up is the demand-supply imbalance. In those markets, it is more to do with supply because there is such large deficits being run and will continue to be run in the future given how much the interest burden is going up. And in India, the demand-supply imbalance is more because of lack of buyers for long-dated bonds.
Right. And so, obviously, you can't comment on the price itself, but what's your view of this going forward? Like, is it for a consumer, is it a good time to think about investing in bonds, let's say in India, or is it something that will continue in this fashion?
Yeah, so I think if you look at the real yield you get on a bond today, it is actually a quite comfortable. The challenge was investing in bonds or in fixed income instruments in India always has been that post-tax real returns are negative, right? Now, yes, tax is still an issue, but if you ignore tax, the real yield on these instruments are now quite reasonably attractive.
Because inflation has fallen.
So you have inflation today at about 200 basis point and a 10-year bond is yielding 6.7%. So you have an attractive real yield. But that is only as an accrual strategy. Like what is the coupon? We don't expect any major appreciation. See, appreciation in a bond comes when interest rates fall. If the yield. So we are not really expecting the yields to come off materially. We believe RBI is now has already reached the end or nearing the end of its rate cutting cycle. If you see their projections of inflation next year is actually 4.2%, and it went up by about 10 basis points last week in the latest monetary policy, right? So it's unlikely that there will be kind of more monetary support coming in terms of rate cuts. So we are not expecting yields to come off, and therefore from a capital gains perspective, bonds may not really make too much sense, but just as a store of value and provide you a real yield, they are at an attractive price.
Understood. So yield curves are looking wonky because of the demand supply situation. In global markets, it is that the government is issuing so much paper, they are taking on so much debt that they are issuing so much paper that there are not enough buyers, hence the yields are going up. In India, it's the other way around, where the number of buyers for the paper are very few, and as a result of which the yields are higher. You don't see this changing materially in the future, but given where the yields are, the inflation adjusted is the yield minus the inflation rate is very attractive from a longer term perspective. So it may be a interesting time to look at this from a yield perspective. Yeah. Let's move to the next asset class, which is commodities, which is where I think the most action has happened in the last month or so. Yeah. So actually more than last month, but Ashish, what's happening? What's happened to gold as an example? It's kind of 3x in the last three odd years, 4 years. So
I think a lot of excitement towards commodities has come because of its property as a store of value or as a hard currency, right? Historically, when there were period of risk averseness, people used to flock to certain currencies that used to hold their value, and prime among those used to be the dollar, right? With all the policy making challenges that have transpired in the last 3 years in the US, all the debt issues or fiscal deficit issues in the US, clearly confidence in that currency has gotten shaken, and people are looking at other stores of value. About 18 months ago, that led to a change, particularly in central bank behavior, where central bankers started to diversify their assets and started taking gold as one of the assets in their reserves. But very quickly, in the last 12 months, it's moved into various base metals. So it started with gold and went to silver, to copper, and now virtually every base metal is being kind of seen as a play on it. There is logic behind it, that in an era where every currency is being debased because every country wants to kind of export more, wants to manage their debt, and debasement of the currency, the easiest way to do it. I think that challenge will persist. But again, one has to be slightly wary of narratives, and I believe de-dollarization is a very risky narrative. Because I was looking at some data that despite all this talk of de-dollarization, last year foreign investors bought $1.7 trillion worth of US assets, right? And this amount was 30% higher than what they bought in 2024, right? And not only did they buy US equities, they bought $1 trillion worth of US government bonds and US corporate bonds. Right, so there is still people going in, and people have no choice but to have dollar as or dollar assets as part of their core holdings. The second risk in many commodities is also that except for gold, most of the other commodities, including silver, have industrial uses, right? And when there's a sharp spike in price, industry cannot keep affording to fail. So there is a negative elasticity of demand, right? And you will see the demand come off as the price moves, right? So the demand-supply balance of these commodities actually keeps changing as the price moves. If you look at metals like silver and copper, they are also, they don't extinguish, right? So they are literally perpetual. So every year, whatever new supply comes in, that keeps adding to the stock of copper or stock of silver that is out there. Right, and we have seen in previous cycle in the past, in 1990s, early 2000, for example, when copper prices spiked, people pulled out copper wiring from their houses and replaced it with the plastic wiring. Right, so that entire stock is also available to be recycled and put back into use if the price is high. So people have to be very careful with the industrial commodities. Because the demand-supply balance can change very rapidly, and supply is not just the supply you are extracting from the ground every year, but actually all the stock that is already existing on Earth.
Understood. And if you take a more near-term view of events, what's happened, like those extreme volatility on some of these. So I
think the reason was that the prices was being just driven by financial demand,
Right.
Right. So you see the amount of money going into gold and silver ETFs globally. That is what was creating all this demand and speculation was reaching maniacal level, right? So if you see the silver price curve I think from November to January, it went up more than 2x, right? So the price curve went parabolic, and when it turned, it turns with a even sharper velocity, because there are margin calls that get hit, and positions have to be, leverage positions have to be unwound quickly.
Understood. So that's kind of on commodities, which is the industrial commodities, which the demand is driven by many things, but there is a real world application, which is cost of goods for someone.
Yeah.
And so they can only, take so much of an increase in that cost of goods. If it goes up a lot, then they'll stop, or they'll kind of cut down their usage.
They'll find substitutes.
They'll find substitutes, and they'll find some other ways to get the same work done.
Yeah.
And so one has to consider the demand supply situation fully. Gold maybe is a special asset class that it doesn't have so many industrial users. People are thinking of it as a real hard currency that,
But even in gold, a large part of demand for jewelry, etc., also sees in tonnage terms,
right,
negative elasticity with price increases.
With price increases. So people actually don't say that I want to buy 10 grams of gold. They say I want to buy 100 rupees of gold or whatever.
Yeah.
20,000 rupees of gold to give someone.
Yeah.
Now that 20,000 can sometimes give 10 grams, sometimes they give 12, sometimes they give 8. Yes. They don't really bother so much. So so there is negative elasticity of demand, even in gold. Yeah. But then for large segments of buyers like central banks, etc., they are thinking of it as a store of value, and that has increased. But as you said, this de-dollarization is not, it's not obvious that it's going to happen in the near term. Yeah. It is a very long drawn kind of a process. So that is not the immediate bet for the gold prices to go up. It is technical factors outside of that that's kind of taking it up. What's happened to real estate, Ashish?
So I think what's been surprising to me over the last 3 years is the pickup in real estate that we saw post-COVID, right? And it could be driven by the fact that rates were low. It could be driven by the fact that people started spending more time at home and they wanted to buy bigger houses, or people had excess savings from the time of COVID, has largely continued across the world, right? And even after 2022-23, when the monetary tightening started, and not so much in India and emerging market, but in the developed world, when rates went up so sharply, you have not really seen any collapse on the real estate side, right? Because their mortgages are floating rate mortgages, they get reset, and we have actually seen real estate markets across the world settle at a higher norm than norm prices. What we have started to see in the last 6 months is that real estate prices are still holding, but the real estate market volumes have started to come off. And that is visible in the US, it's visible in India, even mortgage market in India, that has also kind of rolled over. It's kind of slowed from high teen growth to low teen growth. And low teen growth, remember, also includes the price appreciation, right? So the volume growth has actually come down to single digits. But thankfully, as of now, the market is stable. One good thing that has happened is over the years, lot of leverage has reduced in the real estate ecosystem. And if you speak about India in particular, the developer balance sheets are actually pristine. virtually no one carries debt. And therefore, they are in much better position to kind of withstand any slowdown in demand, right? It's very unlike the situation we had in 2017-18 because there was so much leverage in the system. A downturn led to literally fire sale and developers going under. So there is no kind of panic in the market, but a slowdown is visible across multiple markets.
Understood. And now last currencies, what's happening in that space?
So I think we spoke about de-dollarization, and I think the first trigger point was when the first tariffs were announced. But actually, surprisingly, in the last 6-9 months, the dollar has again not lost a lot of value, right? And one of the reasons is that U.S. economic growth has again belied expectations. We again saw some risk to the dollar earlier this year when there was talk about risk to the to Fed's independence, right? But again, with the appointment of or nomination of the new Fed governor, people are becoming more confident of an independent and a rational Fed, and we have again seen dollar appreciate. What's been surprising is that not so much India's kind of Indian currency move against the dollar, but really a move against some of the other currencies. So compared to the euro, last year we lost almost about 21-22%. So it is kind of surprising how dramatic the change against those currencies is because I think India's macro fundamentals were not really that poor, right? And I think it is just, so even though we had tariffs imposed on us, our current account deficit this year will also be within 1% of GDP, right? So it's not that despite the tariffs from the US, our current account deficit, if you recall 2013-14, our current account deficit used to be 4%, right? So this time the current account deficit is much shallower. So the depreciation we have seen in India actually again has been more to do with the weakness we have seen on the capital account. So earlier we used to run a high current account deficit, but our capital account used to always be in surplus. The challenge this time around has been that our capital account, both because of, again, of the FDI and FII flows, has been under pressure, right? Our gross FDI inflows even 7-8 years ago used to be $50-60 billion. That's about $80 billion today, right? Or both last year. Our FDI outflow used to be $20 billion, but that is also now $80 billion, right? So last year our net FDI was practically nothing, right? So this $80 billion of FDI outflow or repatriation coupled with FII outflow is really challenging the capital account, and that's what's causing the pressure on the currency.
Understood. So Ashish, we covered kind of all big asset classes. A couple of questions we got from the audience, which I'll throw at you. First is, as people think of investing, particularly in IPOs, what are 2 or 3 things that they should keep in mind?
So just based on empirical studies, so I think one thing I have seen in terms of IPOs typically which are larger than 10,000 crores historically have provided a negative return over the next 1 year, right? So we spoke about what are the average returns over various maturity. Secondly, IPOs that don't get subscribed at least 10 times by retail, typically those are no-go IPOs. So the probability of those IPOs succeeding in terms of post-listing returns are higher. And actually the sweet spot for retail investors are IPOs that are oversubscribed 20 to some 35 times. So basically, you look at what is your expected return based on the probability of allotment and the gain, right? So that is the range of oversubscription that is kind of most conducive, has the maximum expected return, and typically mid-size IPOs are better than the larger IPOs. Beyond that, I think I would just say that people should look at investing in IPOs like they look at investing in any other company. They should look at the industry, the company, whether they like it or not, whether the valuations make sense or not.
Right. So some data, but then fundamentally look at the company and evaluate it independently and see if it makes sense. Not every IPO, in fact, 50% of IPOs, as you said, have delivered negative returns over the last 2 years, and overall average is itself 4%. Second, if I were a investor and I had 100 rupees, given today's situation, like I have today to invest, how should I think about all these asset classes?
So I'll kind of leave real estate out of this because I think real estate is a lot more emotionally driven, etc. There are multiple other drivers. But if you have like $100 of financial assets, then I would say that about 50-60% should be in equities. You have 25% in debt. You have 15% between foreign equities and commodities.
Understood. So even sitting today, because people are looking for you're thinking from a longer term perspective, for someone my age, my demographic should have a material allocation to equity, 50-60%, followed by bonds and followed by commodities. So Ashish, thanks a lot. We covered a large range of topics and in a very interesting period where markets have been very volatile. Many folks entered the equity market post-COVID and they've only seen a one-way kind of a ride. And hence a lot of the noises you hear or a lot of emotions you hear are one of despair, saying that last year we've not seen any returns. Actually, the market has not done that badly. I think perhaps the emotion is far more negative than the state of the market because the expectations are set so high and reality has come to roost. Now we spoke about equities where for a number of fundamental and technical reasons, high valuation, actually higher than normal valuation, slower earnings growth, and in addition to that, significant infusion of supply through IPOs and secondary sales and the like, have basically kept prices on a tight leash. In many cases, it has fallen as well. Going forward as well, the flow of IPOs is not going anywhere. Actually, for this year, 2 lakh crores of IPOs are already in the works. And if we add secondary sales, that number is going to be around 5 lakh crores. So significant amount of supply is likely to enter the market. On the demand side, SIP flows continue, but FIIs are kind of still taking money out. There is likelihood that at some point in time this may reverse because earnings growth looks to be coming back, but that's not clear that it will come back. So this is a space that we can't say with full confidence that next year is going to be great. Longer term, obviously, India equity story should be good, but there are headwinds. Bonds we spoke about that from an interest rate cutting cycle globally as well as in India, it looks like we are close to the bottom. There is not much more left to cut. Having said that, the yield curve is very, very steep. At the longer end, despite all the rate cuts, 10-year bond yields have actually increased. And that has increased globally because of a lot of supply. Governments they have large fiscal deficits, they're issuing paper, and hence yields are going up. In India, there are not so many buyers, and hence the yields have gone up. Again, this situation you don't see changing. If you are looking for coupon, it's a good time to invest because the real interest rate difference between the yield and the inflation is quite comfortable because inflation is so low. But you are not envisaging a significant capital appreciation here. We spoke about real estate where post-COVID and even in the last 18-24 months, prices have gone up significantly or initially significantly and then steadily. But again, that's another space that you think immediate term returns are going to be quite muted because of, again, demand supply situation there. And last we spoke about commodities where again, for various reasons, the prices have run up significantly because many people have thought of this as a store of value, and a lot of financial interest has moved into commodities given whatever else was happening in the world, all the uncertainty and the like, and kind of a lot of financial interest moved into commodities, which has resulted in the prices going up. But also, when there was a trigger, the prices came down as sharply because it was financial interest or not fundamental interest. And in the commodity space, we have to keep looking out for the fact that demand supply is very elastic, in the sense the elasticity to prices is quite high. So if prices go up, demand will fall, and so it should just naturally course correct, which is your view that is what has happened in commodities, and that's something to look out for as well. Overall, as if somebody has excess money today, they should continue to have a diversified portfolio with 50-60 being in equities, and then maybe another 25 in bonds, another 15 in commodities. This is from a long-term perspective. Obviously, you're not making any short-term recommendation on prices, etc. And so being diversified, thinking about fundamentally where you're making your investments is critical, as always. And that's what you would suggest all our viewers to do. Thanks a lot, Ashish, for a very interesting conversation.
Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.